The customer who cannot log in, cannot get a file back, or cannot pay a bill does not call the vendor. The customer calls the name on the bill. Buying from a vendor procures a service. It does not move that call. You still own the 5 risks because buying from a vendor does not transfer the impact. The customer still calls the organization. A purchase order relocates a task. It does not relocate the blast. TPRM has to keep the imported harm on the organization's ledger. Third-party risk management has to keep imported harm on the organization's ledger. TPRM that treats a purchase order as a transfer will still answer the phone. TPRM does not erase that risk. A company that uses other companies will import some of their failures. The work is to keep the imported failure inside the board's appetite. Appetite is not a feeling. Appetite is the amount of damage the board will still accept after a vendor is wrong. Impact is the harm that lands on your side of the written contract. A clause can move money after a fight in court. A clause cannot move the outage, the leaked file, the fine, or the headline. You can delegate the act. You cannot delegate the blast. The account, the data, and the name the customer paid were yours. The transfer illusion is the belief that a purchase order relocates the blast. Procurement bought a service. Legal signed a transfer sentence. Operations received an uptime promise. None of those desks took the phone. The customer who lost a file still dials the brand. The regulator who opens a case still writes the name that collected the data. The journalist who writes the headline still prints the logo people already know. A risk type is a class of harm, not a committee. 5 classes cover the vendor path: cybersecurity, operational, compliance, reputational, and fourth party. They are not 5 separate programs. They are 5 ways the same relationship can hurt the business. Each type has a what and one picture that holds. Cybersecurity risk is the first type. Confidentiality means the wrong person cannot read the data. Integrity means the wrong person cannot change the data. Availability means the service is there when the business needs it. Those 3 words are the CIA triad, and a vendor can break any one of them. A cloud human resources application with weak login rules can leak employee files. A managed service provider is a company you hire to run systems for you. And if that provider holds broad admin rights, an attacker who enters the provider can launch ransomware inside your network. The employee who cannot open payroll does not call the provider. That employee calls you. Operational risk is the second type. It appears when a vendor's systems, people, or process fail, and the business cannot do its work. A cloud region can go dark. A vendor can ship a bad update. A recovery plan can exist on paper and fail the first time someone tries it. No attacker is required. The CrowdStrike sensor update in 2024 is the public picture. A flawed update knocked large numbers of Windows machines into a crash screen. Public reporting treated it as an outage, not as an intrusion. A clinic that cannot chart does not wait for the vendor's post-mortem. The clinic is already your clinic. Compliance risk is the third type. It appears when a third party breaks a law or a rule while holding data on your behalf. A payroll processor that mishandles employee records can trip GDPR, which is the General Data Protection Regulation. A healthcare vendor that mishandles patient records can trip HIPAA, which is the United States Health Privacy Rule. Regulators treat the organization that collected the data as the party that must answer. The written contract can name the processor. The license to hold that data was still yours. The fine, the mandated audit, and the corrective plan follow the name that collected the records. Reputational risk is the fourth type. Customers, regulators, and partners lose trust because a third party failed, and they do not split the blame. A marketing platform that leaks a customer list still shows your logo on the apology. A contractor that posts personal data still shows your name in the headline. People outside the building do not hold a map of your subcontractors. They hold the brand they paid. Trust returns to the name on the bill, not to the name on the purchase order. Fourth-party risk is the fifth type. A fourth party is a vendor's vendor. Your supplier may depend on a subcontractor, an open-source library, or a cloud you never reviewed. Open source means software published for anyone to use, often without a written sales contract. The invoice named the integrator. The hop was already in the path. If that hidden node fails, you may learn about it only after the outage or the leak. The data that left the fourth party was still your data. Fourth-party risk is one of the 5 types, not the whole program. The teaching point is ownership of the hop, not a map of every supplier of a supplier. Those 5 types sit on one table because they travel together. Cybersecurity risk is a CIA break, and the picture is a leak or a ransomware launch from a provider. Operational risk is a vendor failure, and the picture is a halt with no attacker required. Compliance risk is a third party that breaks a rule, and the picture is a fine on the organization that collected the data. Reputational risk is a drop in trust, and the picture is a headline that does not print the vendor. Fourth-party risk is a vendor's vendor, and the picture is data you never reviewed, still leaving. The organization still owns the impact in every row, because the customer still calls the name that collected the data. A single vendor week can trip all 5 rows. A support provider is entered. Customer files leave. The help desk stops. A regulator opens a file because the records were regulated. The apology carries your logo. The attacker reached you through a subcontractor the invoice never named. That is not 5 incidents. That is one relationship lighting 5 classes of harm. TPRM that files the 5 types in 5 inboxes will keep missing the week. That is why the 5 types belong in one ledger instead of 5 inboxes. Financial health, operational stability, cybersecurity, and reputation sit together, because a vendor that is solvent and still sloppy with admin keys can ruin a quarter. Solvency answers whether the firm can pay its bills. Ownership answers whether the blast still lands on you. Those are different questions. A thick written contract can win the first and lose the second. The ownership test is the phone. If the customer, the regulator, or the journalist would still dial your number, the impact is still yours. Buying from a vendor does not rewrite that number. Treat the vendor as an extension of your own systems. A weakness you would not accept on an internal admin should not be acceptable on a vendor admin. The cost of that standard is paid in intake and evidence. The cost of skipping it is paid in a quarter you do not get back. A support provider is entered, and 1 week lights 5 rows. Customer files leave. The help desk stops. A regulator opens a file. The apology carries your logo. The hop was a subcontractor the invoice never named. TPRM that files the 5 types in 5 inboxes will keep missing that week. The 5 types belong in one ledger, because the customer still calls the organization. Thank you.